presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management Market Update for the July 19th, 2022. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. Looking at the markets, let's talk a little bit about inflation, CPI. That's what's driving most of the market. I'll talk about the Fed this week and next week, what the Fed is going to do. A little bit about the energy market, the weekly technical analysis, where the meter is as far as the market is concerned. Market meter is looking a little bit better, and the outlook for the week ahead. Let's start with inflation and the CPI. Where is the inflation coming from? That's really the last inflation number. When you dig down into it and see what it looks like, what we're looking at is the major component culprit for inflation has been the energy market. And if you look at 12-month percentage change in the CPI index, selected category, energy and commodities are the ones that are contributing the most, and energy services are second. So that's where we are getting most of the inflation from. But if you look at inflation, the energy prices, and I'll talk a lot more about that, and we'll take a look at the chart, where are the prices right now? And we will take a look at that. Whereas in the U.S. inflation, it's coming equally from energy, it's coming equally from wages, it's coming from housing, and it's coming from supply chain. Well, we're seeing the housing market come down. The NAHB came out with numbers, and that's the National Association of Home Builders. Their numbers dropped dramatically, their confidence numbers, and I think housing will slow down. You've heard me talk about that for the last year, where I think we've pulled forward most of the appreciation for the next couple of years as the market has gone up so much. We are going to stabilize, or maybe even go lower, but I don't see a crash in the real estate market, but I think prices will, the appreciation is going to slow down, and that will definitely take out a lot of the inflation that we are getting from housing. Supply chains are getting better. We'll take a look at those. Wages are still up, but we are starting to see companies lay off. We had Apple announced yesterday that it's going to start slow down hiring, and that pushed the Apple stock down a little bit yesterday. It's back up today, but most major companies are now starting to slow down their hiring. At least they're not laying off, but they're slow down the hiring, so the job vacancies numbers are going to start coming down. Energy, on the other hand, has come down quite a bit. When you look at the UK, most of the inflation is coming from energy prices. Wages are also contributing. Housing has not been a major contributor, and the supply chain has not been such a big. All of it is coming from energy. Same thing in Europe. Most of the inflation is coming from energy prices, a little bit from wages, supply chain issues, and housing. But again, most of it is from energy. So energy is the main culprit, or oil prices, which went up to $130 a barrel after the invasion of Ukraine. But since then, we've seen prices hit as low as $92 a barrel. We're back up above 100. I believe we're going to see prices somewhere between 95 and 110, depending, as long as we do not have any external shocks. Again, personal consumption, this is the indicator that the Fed looks at, the PCE as it's called, or the Personal Consumption Expenditures Index. That's what they look at, and it continues to go up. But we feel it's about 6% right now. The Fed would like to see it at 2%. We feel that it should drop to somewhere between 3.5% to 4% sometime next year, but we expect it to start slowing down. When are we going to see the peak, and when are we going to see it tip over? That's going to be the biggest inflection point, I believe, for the market that we have to look. The Fed this week, again, we have an inverted yield curve where the 2-year has gone above the 10-year and stayed above the 10-year. So that is a big number of months inversion to market peak. Usually the inversion happens first and then the market peaks a little bit later. But what has happened, if you look at the market, the speed with which these markets interpret data and move has become much more compressed, where we see bigger moves in shorter periods of time rather than we saw historically. And what that, I think, is due to technology, where the information, everybody has it. They get it a lot faster than they used to 10, 20, 30 years ago. And that is why they react a lot faster and the markets react a lot faster. So I believe the market is inverted. It's starting to show where the 2-year interest rate is higher than the 10-year interest rate. That usually indicates that we are going to have some kind of slowdown or recession in the economy. The Fed, I believe, is going to raise interest rates by 75 basis points or 0.75%. After the CPI number came out, the percentages, the odds for 100 basis points or a 1% increase went up to about 90%. They're back down to about 30% now, and most of the market is expecting a 0.75% interest rate increase by the Fed. I believe the Fed will do this interest rate increases, but a lot of people not paying attention to the Fed balance sheet. That is the amount of bonds that the Fed holds. As you know, they went close to $9 trillion, the amount of bonds that they were holding. Now, when you have $9 trillion worth of bonds or CDs, they mature. A whole bunch of them, 95 billion of them, mature every month. What they were doing historically is when the 95 billion matured, they were putting those back or buying new bonds or putting $95 billion back into the economy. What the Fed is starting to do now is as they mature, they're going to what is called the runoff. As they mature, they're not going to buy new bonds, or they're going to pull out $95 billion out of the economy. And that is in essence going to decrease liquidity in the markets, in the economy, and that is in another way of raising interest rates or taking liquidity out of the system. So I think the Fed is going to start looking at September, depending on how we get the CPI numbers, the inflation numbers in July and August, and September before the September meeting, and that's when the next meeting is after July 26th, 27th meeting, and they will take a look at it. If inflation starts to roll over, probably the Fed will start taking the foot off the brake and not increase by 75 basis points and reduce it to 50. That's where we see the turning point in the market. As you've heard me say for the last 6 months, when the Fed takes the foot off the brake or starts increasing rates at a slower pace, that will give the market the opportunity to start moving higher. Again, interest rates will continue to move higher, the economy will continue to slow, but remember, the market looks ahead. It's a forward-looking mechanism. It's a discounting mechanism. So the market will start moving ahead of the fact, looking at, okay, 6 months past, in the future, what might happen. And if the Fed starts slowing down the interest rate increases, we see inflation slowing down. That's where I feel the market will start. And the market is trying to find a bottom. Here, we're starting to show some positive signs in the market from a technical perspective. When I take a look at the technicals, we'll take a look at those. Again, the probability is an 83% probability that we're going to raise interest rates by 75 basis points. And then there is another somewhere around 25 to 50 basis point increase, 80% probability in September. So we will see where we end up with these rates depending on what inflation looks like. Energy prices, you can see that the oil prices are down about 11% from the June high. They've fallen off, and we were below 100. Now we're slightly above 100 today, but we have come back down, and that is taking pressure off the inflation number. You can see gasoline prices on a national average were close to $5. We're down to about $4.73 now, and the prices have come down about 25 to 30 cents a gallon in gasoline. That is something that everybody as a consumer watches very, very closely. Energy dependent, Europe is the most dependent on energy, especially from Russia. China is very dependent on imports. We are not. We are a net exporter, and Russia is the biggest exporter of energy, one of the largest in the world. Taking a look at the technicals, interest rates are sitting right at the 50-day moving average for the 10-year yield. We came down after making this fifth-day top. We have come down a little. We can bounce around here. And now it seems if we have seen a peak in interest rates at 3.5 for the 10-year, that might be the turning point for the market and might give the market an opportunity. Again, I saw the fifth wave bottom that we talked about. Everything moves in 5 waves. We saw the fifth wave top right here in January of this year. We started a wave count to the downside. Now we've got 1 wave, 2, 3, 4. This was 4, and now we've seen the fifth wave. Everything, once we see a fifth wave, then we either get an A, B, C correction, A, B, C, or we start a wave 1 to the upside. This could be 1, this could be 2, and we could just starting wave 3. But this is the 50-day right here, 39.22. Today's high so far is 39.16. If we can get above 39.22, that would be a very positive indication. The next resistance will be around 4,017. There's this tiny gap here on the charts. This gap gets filled, that would be a very positive, and that gets filled at 4,017. If we can get above that, that would indicate to me, at least short term, we might have made a bottom. When we look at the weekly charts, again, we have to get above somewhere around 41.14 to say that we have made a weekly bottom. But the markets have come down. We're coming up against this downtrend line right here. We have a little bit more room on the upside, but 39.22 is the 50-day moving average for the S&P. Getting above that would be a very positive indication. Looking at the Nasdaq, today we broke out above. The 50-day on this is 11,525. Today we are trading at 11,636. So we are above the 50-day moving average. This is the first time we're seeing that since about April of this year, and when we broke below it. And really, right here is when we got below the 50-day, which was somewhere in February of this year. So I think this is a good sign that we're starting to get off. The gap here gets filled at 11,750. That is the next resistance. We can fill these gaps at 4,017 for the S&P and 11,750. That, at least for me, would be a short-term bottom. Will we continue higher from there? That'll depend on inflation. That'll depend on what the Fed does. But technically, it looks much better. Nasdaq Composite and weekly, my dot plot gets positive 12,800. So we have a way to go, but that would be, as you know, once the market gets above these dots, market is above it, this is the market, these are the dot plot, it is in a bullish market, and that happened in April of 2020, all the way up till about January of this year. January of this year, the dots went above the market, and that is a downtrend. When the market can get above this dot plot, that would be an uptrend, but we're not there yet. So that's the way I'm technically looking at it. Crude oil came down to the 200-day moving average. It's trading at the 20-day today. Resistance is 109. We're trading at about 104 today. So 110 to 90, 92, 93 is going to be the range in the oil market. Gold went down to just nicked the 1700 mark, but it looks like a fifth wave bottom right here in the gold market. Seems like we could get a bounce if the Fed is not raising interest rates. It slows down the interest rate increase after the increase next week. That could be positive for gold. What has been putting pressure on the gold market all year has been interest rates. As they go up, the dollar goes up, and that puts downward pressure. We could get a bounce in the gold market back up to about 1,800, but interest rates all around the world are going up. We're expecting the ECB, the European Central Bank, to raise interest rates on Thursday, and that could also put some more pressure on the gold market. Long term, I think there's other opportunities rather than gold, but if you have to have gold, the 1,700 mark looks like an opportunity in the gold market. Market meter, I'm still 50-50 on the recession. I'm starting to get a little bit more positive. I'd say I'd go up to about 55 for the market meter, getting a little bit more positive on the market because of the technicals. And the chance of a recession are still there at 50-50. Outlook for the week ahead, we're going to see the Fed raise interest rates. The market is going to get some anxiety ahead of that meeting. Maybe they'll do 1% instead of 3/4. But once they do that, and then the Fed commentary is going to be important to see what the Fed is thinking about raising interest rates. And then we are going to look at earnings. Those are going to be a major driver over the next couple of weeks. And if earnings hold up, which everybody's saying that they are expected to hold up, but a lot of people are saying no, in a recession they're all going to go away. But if earnings hold up, which they have so far, that could be another positive for the market. Those are my views, those are my thoughts, those are my opinions for the market. Again, if you need help with your portfolio, go to compak.com, compak.com, or make an appointment. Stop by the office, or just call pound 250 on the cell phone, talk to Mo, and that's what you dial, that's what you say, and we will be more than happy to do an analysis for you of your portfolio. I'm Moe Ansari. I will be back next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.